Welcome back to the IT Investor Podcast. I am Pramod here with my co host Wally. Today, we are covering everything you need to know about passive investing. We have touched on pieces of this topic in our prior episodes, but we wanted to bring it together in one clear, start to finish overview. If you find this useful, please explore the back catalog. We have other episodes where we go deeper on related concepts, deal evaluation, and the mechanics behind returns. Today, we will define passive investing, explain why it tends to fit most IT professionals, walk through the main ways to invest, and then focus on multifamily syndications, since this is one of the most common paths for passive investors. A quick disclaimer: this is for educational and based on our experiences and opinions. It is not a financial, tax, or a legal advice. Please do your own diligence and consult qualified professionals. Hey, Wally, how are you?
Vermont, I'm good. It's Friday the 13th and tomorrow's Valentine's Day. I can't think of a more exciting weekend.
Yeah, right. So you are all prepared up?
Yeah, my wife and I, we kind of take Valentine's Day kind of easy. We're not like, we save money on the gifts. We spend time with the kids. We just kind of hang out and enjoy it together as a family. So, yeah, going to be a nice chill weekend. How about
Yeah.
you?
Mine is also kind of like the same thing. I mean, we actually don't have like a tradition of this celebration of Valentine, back home when we were growing up. But these days, now the newer generation or the younger generation, of course, they are following all of these. What do you call this? Like a westernization and
Sure.
something, right?
Yeah.
Yeah.
It's a fun holiday for the kids. Go to school, get your candy and your cards.
Oh, yeah, that's interesting, right? I mean, especially the elementary school kids, they get a lot of candy and cards on this day, right? And after coming home, they stack them and count them, just like a mini
Yeah,
Halloween,
totally.
right?
Yeah, yeah, it's
Yeah.
fun. Well, hey man, I know we're going to kind of review a little bit about our favorite topic of passive investing as IT investors. I'm going to take a kind of a slightly deep dive. We're not going to go super deep because we do have other episodes that we've recorded in the past that folks can kind of take a look at the catalog if they want to go into specific topics. But the main focus for us is if you work in IT, and if you're carrying that heavy workload, as a lot of us are, 40 plus hours a week, 50 hours for some of us, maybe even more than that, and then you and I both being dads, our weekends and our free time is really important. So passive investing can be a clean way to get real estate exposure without adding operational responsibilities to your schedule. None of us want a second job. So passive investing can be a way to do that. So we're going to keep this straightforward. We're going to talk about what it is, the main options that you have to be a passive investor, how returns work, some of the risks that matter, and questions you should definitely ask before you invest. So, Pramod, would you mind telling everybody online what passive investing really means to us?
Yeah, sure, Wally. I can definitely answer that. This is one of the most common question which always comes around, right? Basically, what passive investing means is you invest capital into a opportunity or a deal where an operator is responsible for executing the business plan and managing the day-to-day operations. Now, your role is to evaluate the opportunity, and then the team upfront then monitor the performance through whatever reports you get from the operator and their communications, of course. Now, this structure shifts your time commitment away from the operations, and you just have to make a selection and do an oversight of the operations. Now, Wally, for many IT professionals, that shift is the point, right? It allows them to participate in real estate without taking on, as you said, a second job.
Yeah, absolutely. I don't need a second job. I don't even want my first job for very much longer, right? I'm trying to have no job eventually. Let's think about this as to what we're most responsible for, kind of that front loaded upfront process when we're passive investing. You're going to do your due diligence. You're going to set clear expectations, and you're going to make sure you stay informed through consistent communication with the operator. If you're someone who likes clarity, passive investing can fit well because you can evaluate the people, the plan, the numbers, and the incentives before you commit to an investment. So, Pramod, would you mind telling why most IT professionals choose passive investing?
Yeah, sure, Wally. As we were alluding earlier, the first or the main reason why many of our IT investors choose to invest passive investing is because we are already busy, right? I mean, with our deadlines and occasional on call responsibilities, whether it is during nights or on weekends. So, passive investing, it reduces the operational demands on our calendar. And second, the income profile. I mean, we IT professionals have the ability to deploy capital in a meaningful and passive vehicles. These are designed to convert our capital into ownership and potential returns without requiring our involvement. Now, the third reason could be the mindset, right? I mean, IT professionals are comfortable at evaluating risk, reviewing the assumptions, and making decisions with incomplete information too. And that translates directly into sponsor and deal evaluation. Finally, this is my favorite, long-term planning. Many people want financial resilience over the time, including income streams beyond their salary.
Yeah, Pramod, I'd add one more practical point. A lot of us IT professionals want real estate exposure, but we also want evenings and weekends back for more time for things we enjoy, time with our families. Passive investing in real estate supports that because our involvement really is just concentrated in that upfront diligence process and kind of monitoring throughout the course of the hold. We're not caught up in those day-to-day operations. And the skills you already have, as an IT professional, they really help. You know how to evaluate systems, you know how to ask precise questions, and those skills definitely apply here. So we have a lot of options when it comes to passive investing in real estate. Pramod, would you mind sharing with our listeners what are some of the main ways we could do that?
Yeah, Wally, passive investment can take several different forms. The first is most widely known, which is the publicly traded REITs. These are accessible through brokerage accounts like Fidelity or TD Ameritrade, something like that. And here you deploy your liquid cash, and it is simple to own. All you do is you create your login online and buy those shares. Now, the second one is the private real estate funds. In this case, manager pools capital across multiple assets or strategies, and this can provide diversification, and it requires stronger diligence on the manager and as well as our investor. The third is the private lending, where we provide capital secured by real estate and earn a defined return based on the underwriting, the borrower, and the collateral. Now, the fourth is turnkey rentals where property management. What I mean by that is you own a specific property and you outsource the day to day operations to, say, a property manager while still holding the direct ownership and concentrating the risk. Now, the fifth and the most popular one is the syndications, which we normally hear more when people do present their webinars and all that sort, right? So, in this syndications, investors pool capital to purchase a larger property, and an operator team manages this investment. And usually that is a multifamily. Wally.
Yeah, I like that list a lot, Pramod, because it kind of you could kind of pick to what your tolerance is. How much risk are you willing to put up? And we'll talk about that a little bit more here in this episode. But which asset class really kind of fits into that risk profile, and then also the liquidity, which is actually liquidity is a risk. Those REITs, one of the points of investing in real estate is to kind of diversify all of your capital in something like the stock market, right? And what I've noticed from my experience in the past is that those REITs they operate like a stock, and they tend to fluctuate with the stock market, and so that almost takes away from that ability of that asset to be a risk mitigation from when markets are doing crazy things, right? So that's why I like actual like hard asset, the actual real estate itself. And you mentioned some of those other two, the private real estate funds or private lending. You're reliant upon doing your due diligence on a strong operator or manager. What really matters about this list is that it helps you match the vehicle to what you actually want. Is it liquidity? Do you want those defined returns like a hard money lender? Do you want direct ownership, like owning a single family rental, or do you want that partnership ownership, like a real estate syndication? I think that syndication draws a lot of attention from us IT professionals because it offers us that ability to scale past one single unit, one single door. It provides those professional operators, professional property manager, and a defined business plan with execution timelines and a schedule. And we'll talk about a little bit more about that coming up here next. But right now, let's take a closer look at what our favorite asset is. That's the multifamily syndication.
So, Wally, let's take a closer look at what a syndication is. Now, a syndication is a partnership structure where a sponsor team identifies a property, they do their due diligence, and after they like the asset, they try to secure financing for it and then execute the business plan. And of course, finally, manage the investment right during the whole period. Now, passive investors contribute capital and they share the returns. So, in syndications, normally, Wally, you do hear two roles, which are the limited partner and the general partner. Who is a limited partner? A limited partner is a person who invests money and they are not active, they're passive, right? And the general partner, on the other hand, is an active person who does daily operations of the property, and they are from the sponsor team. So they handle the acquisition, the financing, the asset management, and last but not the least, investor communications. So, in this structure, returns generally come from two sources. One is during the whole period of the property, which is generally called ongoing distributions or preferred returns or dividends. And the other distribution comes after the asset is sold, that is sharing the property. And that's done in a already agreed business plan. And usually that takes waterfall of distribution of the money. So, Wally, maybe you can break that down in simple terms.
Sure, absolutely, Pramod. Here's a practical interpretation. You're partnering with an operator to own an asset large enough to run it like a business. And that usually means you're going to have a professional property manager. The business plan is built measurables. The business plan is built around measurable drivers like occupancy, growth, and expense control. Cash distributions are driven by ongoing property performance. The refinance or sale outcomes are driven by the execution of the business plan, debt terms, and market conditions. This really brings us as to why multifamily is such a common focus. Multifamily has business fundamentals that are easy to evaluate, right? I mean, revenue, expense, occupancy, and operational execution. That's a framework that most business professionals can get comfortable with.
Yeah. And on the other side, Wally, I mean, there is risk everywhere, right? I mean, even in this multifamily. So you have like the vacancy risk, and the sponsor team should, try to mitigate those risks. And how they can mitigate this risk is probably by doing some renovations to drive in tenants or by doing some operational efficiencies, and sometimes maybe even do concessions during slower months in winter where the vacancy is low, and that could be a leasing strategy. So all in all, outcomes they depend not only on underwriting but also on the execution, which is why risk and diligence do matter.
Absolutely, Pramod. And one of the main things I like about multifamily and risk is that you have that ability to spread that risk across, multiple units. If you're dealing with a single family rental property, that's one unit, vacancy happens, and then suddenly there's no income, and then your risks really do just kind of explode on you. Pramod, would you mind telling us a little bit about some of the different risk types, how they matter, and what do you think about them?
Yes, Wally. Yeah, so multifamilies or in general, this asset class definitely involves some risks. Let me list them. So the first one is the sponsor's risk, right? I mean, it relates to the operator's ability to execute on the property or execute the business plan, and also how the communications are, right? The next one is the debt risk. So this is again, probably dependent on the sponsor is who tries to secure the loan from the bank, right? And we need to dig deeper how the loan is structured, what the interest rate is, and what is the maturity date and timeline on this. The next is the market risk, which relates to the location, right? That's what we heard in real estate always. So how it relates to the local supply, the demand, what is the employment around that area, and what are the rent trends in that location. The next is the execution risk. So this again depends upon the sponsor, how he is delivering the business plan. It includes the daily operations, and is he maintaining the property within the budget by minimizing the expenses, and how quickly units are being rehabbed and leased so that there is less vacancy. Vacancy involves lost income. And the last one is liquidity risk. So this reflects on the reality that many syndications hold capital, where investors are told that their investment is locked in for a 5-year period. But sometimes, due to market fluctuations, or if you have a bad sponsor, so that could go even further, right? So that is the liquidity risk, which I'm referring to.
Yeah. So here's how I would approach a lot of these risks as a potential passive investor, right? That sponsor quality you just mentioned, that's got to come first. I want to know what their communication is like. Are they a competent sponsor? What is their process? A good way to do that is just to ask for examples of previous deals they worked on. Let's see some of their investor updates. What does their reporting look like? Have they actually taken like that's a big one. The last couple of years, a lot of new sponsors popping up. I want to see somebody who maybe has taken something full cycle from acquisition to selling it, right? They haven't done that, then we don't really know how good of an operator they are. The debt that you mentioned that earlier, that's a big one. That's probably maybe number two or maybe number one, really. Understanding how the debt is structured it's big. Is that interest rate, is it fixed or floating? What kind of protections are in place? If it does, the covenants matter. What happens at the maturity of the loan? We're seeing a lot of deals right now that have gone bad because operators were not very judicious with the floating interest rates. Bridge funding, it's biting a lot of operators now. Another one too is it's really important to kind of stress test the assumptions of the business plan. Make sure you ask that operator, whoever's the investor relation person on that GP team, what happens if your rent projections for the next year or two don't actually happen? What if we get stuck in this period of flat rental growth, which we've seen in the last year or so? It's not a good strong deal. Those rent projections, they could hurt, especially if insurance rates go up or if taxes go up. You want to know, how that's going to affect the outcome of that deal. Another big one too, renovations. If you're doing value add, you're flipping a unit and you're having a hard time getting your hands on materials or contractors are taking too long, that affects the project as well. These are all assumptions that you need to kind of stress test. And another final one too is, let's stress test different exit cap rates. How is that going to affect the final sale, the value of the property? We need to take those into consideration. If you can ask these questions to a strong operator, they're going to have answers to each one of those questions that are specific to their business plan. And if they can't do that, maybe that's a red flag that that's just not the deal for you. Pramod, I'm thinking to a recent episode, you mentioned your passive investor checklist. Would you mind sharing a little bit about what that is now?
Yeah, sure, Wally. And most of it you actually just mentioned. So one of the most important thing to check is the sponsor. You know, as you were just telling, ask the sponsor all those difficult or hard questions. Evaluate the sponsor, their experiences, evaluate their team, and also evaluate how their communication is. What we need to look for is honest, transparent. Uh, Communication, right, from the sponsor. So ask these questions and also ask them how they will handle those challenges and what those oversights look like, right? So I would focus more on the sponsor than the deal, because the deal could be good or the asset could be gold and nice and flashy, but in the end, it is the sponsor who controls everything, right? And he can bring that gold into coal, or coal into a gold. The sponsor is very important to my knowledge, I would say. And of course, the next is the deal, right? I mean, you understand the business plan, the underwriting assumptions, the debt structure, and what risks are there and how mitigations are in place, that the sponsor is going to take care. And the last is to protect our investors. How is the documentation or legal documents created? Are these documents like SEC regulated, or is there a SEC lawyer who's drafting these documents? So understand and read carefully those documents before you sign, and also understand what the fees are, how the distribution rules are, what the voting rights are, and the timeline expectations.
Yeah, I would say you probably have a handful of just really quick, easy questions you can ask the investor relations person or the sponsor when you're being presented with a new deal. Things like, what is break even occupancy? If they don't know like how many people need to be renting that apartment complex to just pay all the bills and break even, that's a red flag. What supports their rent growth assumptions, right? It could be the market that they're in. It could be the value add opportunity on the property, but you want to get an idea of what their thought is on why their rent will grow in that apartment complex. You want to get a good insight into what is the capex budget and contingencies. Get a good idea of what happens if that rent growth doesn't happen in 12 to 18 months. Do they have a plan in place? Will the business plan still execute without pushing your debt service coverage ratio below that one? What is a debt structure? That's really important too. And what happens at the maturity of the loan? If you can get clear answers on a lot of those questions or all of those questions, you're building confidence on the business plan based on those fundamentals.
Yeah, I completely agree, Wally. These are really good questions. I would say every investor needs to ask all of these questions and have good answers. And and they should definitely move forward if they get a good vibe on how the sponsor is answering for these questions. Because in the end, you don't want to lose your capital, right? You want to definitely protect it. That's the first thing. Now, to wrap this up, Wally, passive investing is a practical way for many of our IT professionals to participate in real estate while preserving their time and attention. I hope we have covered major passive options and focused on multifamily syndications, including returns, the key terminologies, the risks, and the diligence checklist which they can apply. And if you have found this useful, please explore our other episodes where we go deeper on related concepts and specific deal mechanics.
Yeah, and if you want that one-page version of the checklist we've talked about today, shoot us a message and we'll send it over. Thanks again for listening. We'll talk to you soon.
See you next week.